And welcome to another edition of the Nerdy Agent Podcast. I am your host today, Josh. Luke is out running around hustling and showing homes. Kids selling like crazy right now, but I've got AJ with me. We're going to go over the CPI data that just came out, some of the unique things that happened as a result of how it came out, because the way the market responded to it was a little bit different than usually happens, and we'll kind of explain why. And obviously, we'll continue to talk about what you can expect moving forward. But before we do, Age, how's life?
It's great. And you know what I wanted to talk about first is egg prices. Can you believe the prices of eggs?
You know what's funny is I've said this. So as egg prices have gone higher and higher and higher, they have not affected me at all, because I have been buying the same organic eggs from the same co-op now for 5 years. You know what hasn't changed?
The price of that.
The farmer that's farming locally has not been affected by this.
He probably didn't get the chicken flu.
I'm a little surprised, though. Wouldn't you think that farmer or that co-op would be like, well, the gap between organic and non-organic eggs is shrinking? I was talking to somebody yesterday that said at Cub that 12 cheap eggs, like the $1.50 eggs that everyone's had forever, are now $9.
Oh, yeah. That's where I get them.
But an 18-pack of the organic ones was $7.
Makes no sense.
It's wild, right?
It makes sense.
Well, it makes sense in the sense that the organic farms are not getting hit with the bird flu, but I'm surprised they haven't just played supply and demand a little bit more.
They're keeping their chickens 6 feet apart. But how much have the eggs gone up in the last year? Trivia question for you, Josh.
What, in a percentile or a dollar?
Percentage.
350%.
No, that's a little high, but it is 58.8% higher.
It's got to be more than
for
that.
eggs. That's what they got here.
Oh, man.
So nothing crazy, but kind of like the toilet paper crisis of 2020.
Oh, this is CPI numbers was saying that.
That's the across the country, the eggs. But in our house, kind of like the toilet paper crisis.
Yep.
What did we do when the toilet paper ran out? We got a bidet. And now we got an egg girl.
Do you?
Yeah, we got an egg girl. She drops off 4 dozen eggs once a month. She says they'll last the entire month. And they're $10 a dozen, and they come out of Waconia, which is great.
There you go.
Right down the road.
You could also go to the Lakelands Co-op and get them for $6 a dozen, the same way I always have.
There you go.
But yeah, if you're not eating good eggs, and now eggs are almost as expensive as organic eggs, start trying organic eggs because they're so much better.
They are good, rich yolks.
Yeah. But anyway, inflation, that's what we're talking about today. So that is somewhat relevant. But CPI came out this last week. Tell us a little bit more. What did you learn?
It came in slightly under the estimates, which usually leads to us as a real estate team clapping, cheering, and seeing bond yields drop, mortgage rates come down. But then the next day, the PPI had the exact same thing happen.
Yep.
So for those that haven't listened to our podcast, that's the Consumer Price Index. That's the CPI, and that's a bag full of goods basically that they price out every month, and then they determine how much it went up or didn't go up. And then the PPI would be the Producer Price Index. So that's the items that go into making the goods that feed into the CPI. That also came in favorably as an overall number, but then we didn't see the same reaction that we're used to. Rates were...
So normally the 10-year treasury yields will be impacted by inflation, right? Because if you've listened to our podcast before, you'll know, okay, the data that is coming in feeds expectations in terms of what the Fed is going to do, because if inflation is low, the Fed is more likely to be comfortable cutting rates, which is then going to be trickle-down wise, impacting 10-year treasury yields, mortgage rates, et cetera. In this case, though, inflation came in low or lower than expectations. But what happened to the 10-year?
It actually went up a little bit. So reverse course went the other direction. And I think a lot of this, and we talked before we hopped on here, is that the Fed really, really cares about the CPI and PPI, but the Fed cares more about the PCE, which is the Personal Consumption Expenditure.
We have not spent
Index.
A lot of time talking about this.
We haven't. It's a new acronym for us. Being an acronym named person myself, I love acronyms. And yeah, the PCE, which is coming out 2 weeks after the CPI PPI report, so that'll be the end of March sometime. But the PCE actually takes some of the stuff out of the PPI directly and flows it through. Well, the things that flow through into the PCE were very unfavorable, it seems. These included airline passenger services, portfolio management, physician care, doctors, home health, hospitals, nursing home care, things that really do impact the bottom dollar for consumers in our country. And those all went up more than expected in this last bunch. It looks like most of these items were actually going backwards in several of the months prior, and they all showed increases in the month of February. So that's a number that the Fed thinks ties more closely with what the citizens and consumers of our country are actually experiencing on the ground, versus the CPI, which is just kind of a bundle of goods and doesn't necessarily reflect everybody.
Mm-hmm. And I think, like we've said, there's a lot of different things that are being evaluated at any given time. So much like we talk about with real estate, when someone says, hey, what should I do in this situation? Right? The answer is, well, it depends on a lot of different factors that are playing out, right? So it's never as cut and dry as if there are 3 offers, you offer this way, right? There's your buyer, there's the market, there's the way you've communicated with the other agent, there's the quality of the house, there's how much they want the house. There's all these different things you have to kind of play in your mind to get to an optimal outcome when you're talking about that example, for example. But in this case, it has historically been a little more linear. It's like, well, if CPI and PPI come down and get closer to the target rate of 2, we're going to see more Fed rate cuts, which will bring down the 10-year, which will bring down the 30-year, and which will ultimately help bring mortgage rates into a place where we feel a little more comfortable. But once again, it depends. If there's other components that the Fed is looking at outside of just these 2 things, which they are, right? They're considering the jobs report, they're considering the PCE, they're considering these other things. It's not going to be as black and white, and there are going to be other things for them to consider, which thus makes it more important for you to be thinking about all of these different things as well.
Yeah, and I think the tariffs being on and then not on, and then tariffing this thing and then that thing, and that's definitely a countermeasure to bringing inflation down. Whatever your political opinion is on it, that's more of just a textbook factual thing that when tariffs come into play and domestic production increases, you're not just going to see prices go down when you're making it more expensive for outside folks outside of our country to bring products into our country. So you'll see a repricing, and I think Trump talked about it in his congressional speech maybe a couple weeks ago. There'll be a time of adjustment or something is kind of what they mentioned, and truthfully, that's what's going to happen. Is if the prices go up 25%. Domestic production may increase, and it probably should, but those domestic producers are probably still going to be pricing off of the increase that the other folks experience. So it'll be interesting to see how they compete, if their margins increase or not. And you're going to see this happen across, you've heard lots of things thrown out: lumber, steel, French champagne, I heard the other day.
200% on wine today in Europe is the one.
There you go.
Because they increased whiskey by 50% from the U.S.
Yep. So you see all of these different items, and it will impact lots of goods, and then you'll kind of see a repricing here locally or nationally, and that's going to have an impact as well. And it's very likely a countermeasure to what the Fed's trying to do. So that is probably holding investors at bay, because that stuff doesn't just change overnight. He tariffs steel. It's not like steel just immediately is completely changing in pricing. The futures market may be, but like furnaces aren't all of a sudden more expensive because they have steel in them because of the tariff, but they will be more expensive. So then these investors are all trading on future money. We've talked about this a lot with mortgage rates. Mortgage-backed security investors are trading with a 30-year piece of paper a lot of the time. Most people will dispose of that piece of paper within 5 to 10 years, but they're having to bake in some future expectations and make some really long predictions, and that just makes it for kind of this tumultuous bond market that we've seen recently.
Yeah, and I think when we talked about kind of crystal ball earlier, probably pre-2025, the conversation was, okay, well, people think they know where things are going, but as we've seen, there's a little less stability just globally right now, right? There's still wars going on. We're trying to fix wars. There's tariffs. There's all these different things that are unique to what we typically see. And as things become a little less, maybe predictable is a better way to put it, there's going to be more uncertainty in how people behave. There's going to be more there's going to be more actions that don't necessarily align with what you would expect because the things that are happening are less traditional than what's historically happened. So that kind of puts us in a spot where we can say, yeah, we think X, Y, and Z might happen, but who knows what tomorrow's even going to bring at this point because there's a new announcement every day. So, right now, I think it's important for you as an agent to continue to be very thorough in your daily preparation and what you're reviewing and what you're noting and what you're reading, specifically as it ties more so to the industry necessarily than just global politics, but having an understanding on how those things work together from, listening to past episodes, et cetera, is quite important because every change can have a downstream impact that may impact your clients, that may impact you. And so understanding how they all work together is really important.
And if you are working with buyers and sellers, at least here locally in the Twin Cities right now, know that this market happens every single year and everyone always reacts in a certain way thinking that this is completely different than what we had last year, the year before that. And it's really not. It's the same thing. There's not enough sellers right now. Specifically in a lot of the markets I work in, which are, more school district oriented markets, where people are trying to move, most of the time, presumably in the summer. And so you're going to have to deal with a little bit of choppiness here for a bit, but I think the market will start to open up as we get into the late spring, early summer, and it always does. And we see a little bit easier time for those buyers that were having a harder time maybe in January, February, and March. So
yep.
I think just staying on it. We're gonna get into a little bit better market here, and we're still anticipating. The numbers have started to turn around. I know I made the prediction that we'd have like 5% more sales this year. Came out of the gate really poor, actually 5% down on pendings. But I think, and that's across our macro market here in the Twin Cities. I think you're starting to see that erode away and actually turn back the other direction. I think last week we were even up on pending sales, so I'm still pretty hopeful we're going to see more sales activity, more buyers. And notably, hopefully, more sellers as these rates hopefully stick around where they're at and maybe even continue to retreat down into the mid to low sixes.
Yeah, we need just some certainty. Probably is the biggest thing for sellers right now is going, I don't really know where things are going, so I'm going to sit still again. We've talked about this before, but the more certainty there is, the more behavior there typically is. The more uncertainty, or when things are shifting wildly, there's more people like, I'm just going to sit this one out until things settle down a little bit. So,
and your script of the week should be that, because you're probably having this. We have it on our team. We've had people reach out and say, well, we might be going into a recession. I don't know if I want to buy a house now. And they say, what do I say to this? And I'm like, well, you should dig into their specific situation. If they have a massive threat of potentially losing their job, then that's like a pretty fair reason to not buy a house. Now, if they're in an extremely stable position and they're definitely not going to lose their job, and their situation is such that they probably should move, then global economies, markets, recessions are a lot less scary unless they truly think that real estate prices are going to be depressed, which all of our data points and signs would point to that not happening at this moment. Could that change? Yeah, for sure.
I would even argue maybe the opposite would happen theoretically, right? If we're tariffing things and lumber becomes more expensive and gypsum boards more expensive, then new houses get more expensive, and therefore the old houses likely get more expensive.
And then investment becomes more of a, well, it might become more of a local thing when you're when you're unable to rely on the stock market and things like that. And I think that's why typically real estate prices do okay in a recession. Like in the past, if you look at the past like 7 recessions, we did have the one really bad one where prices dropped dramatically, but in most of them, real estate's flat to up in a recessionary type environment. And it's just because of that, right? There's a bunch of micro decisions being made. These are normal consumers. This isn't the same thing as people buying a bundle of 2x4s, because if you're doing that right now, it's going to be really difficult to predict what they're going to be worth. But housing is a little bit stickier when it comes to pricing, and the Fed has talked about that in their last few meetings of like, man, the real estate thing's been super sticky through all this, and that's how it seems to be, and how it's been going.
Absolutely, and that's all we got for you today on the Nerdy Agent Podcast. Remember, as always, be better.